on.
Yeah, my pleasure.
It's so great to have you.
So you're just saying you made the trek down from $5.99.
You kind of have to be in the office, because if you're not in the office yourself,
they're 100%.
One of the largest office owners in the country here, and you yourself have to be.
Yeah, well, that has multiple dimensions.
Right.
I mean, I have to be for my team at BXP first, and then also for the industry.
Totally.
But honestly, I believe in it. I mean, I think companies are more productive and better the more they work in person.
We do too, and we want to get into that. I got to say, like, before you came on, we were kind of blown away. We were like, how do you have so much time to do everything you do? You're chairman of ULI.
I was, no longer.
We're Real Estate Roundtable. Lehman Brothers Holdings.
Yeah, that's
you were the chairman of, and you're still involved.
By the way, is that officially wound down? Because I know up until not even that long ago, there was still stuff you had to do for it.
Yeah, well, it still exists. Lehman Holdings still exists, and our board still exists, but we're down to, $500 million of assets. We started at like $300 billion, so it's wound down substantially.
I feel like Lehman is the original modern day club. That's the real club. It's Coco's at the GM, but the first form. So I knew that you grew up in Virginia. You've mentioned before that your dad was a local broker. You would go down to the courthouse, read records, and you caught your real estate bug.
Yeah.
Where did you go after that?
Yeah. Well, so I grew up on a dairy farm in the Shenandoah Valley of Virginia, and my dad, in addition to being a farmer, he was a realtor. And the reason he got into it is he was, when any of the local farmers were going to sell their farms, they trusted him the most because he actually owned a farm and was like them. So that was kind of his way to get into it. And he always had that interest in business and so forth. But anyway, when I was in high school, I worked in his office and did some of the things that you mentioned. And, I kind of caught the bug, but I was an engineering student undergrad, and I thought, hey, I did all this hard work to be an engineer. I should try it, which I did. And, I always tell my kids and young people today, there's no such thing as a bad experience, because if you have a job and it doesn't really fit for you, well, fine, you learned something. And I learned that's not what I wanted to do. So how I really got involved in the real estate that I'm involved in now is I went to Harvard Business School and took the real estate class from I would consider him an iconic professor named Bill Pourvu. And, I took the class and I loved all the cases. And then there was a good friend of mine named John Kukral, who was in my section. And he was at JMB at the time, and he's had a very distinguished career in real estate himself. But anyway, he helped me kind of think through, how to get involved in the industry. And then I went to Morgan Stanley Real Estate in 1987.
So were you an analyst or a financial analyst prior to going to HBS?
No, I was an engineer. I was
you were a true engineer.
Yeah, no, I left. I was at University of Virginia. I have a degree in mechanical engineering, and I worked at Texas Instruments in their defense department from 1983 to 1985.
Were you in Texas?
I was in Dallas.
Okay,
in
awesome.
North Dallas.
I'm a Dallas guy. So
is that right? Yeah. I was.
And that wasn't exciting enough?
Again, it was a fine firm, and it was an interesting job. It's just not what I wanted to do.
Okay, so you go to HBS, you leave afterwards.
We went to Morgan Stanley.
You went to Morgan Stanley.
Yeah, and I was there for 24 years, and did real estate for probably 2/3 to 3/4 of it, and then did some things in the leadership of the firm, ran the asset management division. And then my family and I moved to Hong Kong from 2008 to 2011.
And what were you doing there?
I was head of Morgan Stanley Asia.
Okay.
So I was based in Hong Kong, but I worked all over the region, Japan, China, India, Australia.
Wow.
Yeah, and you were there for exciting time for Morgan Stanley Real Estate because they grew some of their highest earning divisions at that point.
Yeah, well, we grew our real estate business in Japan and in China and across the region when I was in real estate. But when I was based in Hong Kong, I was the firm's regional CEO. So part of that was real estate, but I actually spent my time more on other activities. In fact, during that time, that was the time of the financial crisis, and MUFG bought a 20% interest in Morgan Stanley at that time, which is the largest bank in Japan. So we had all kinds of things that we started to do with Mitsubishi Bank, both in the Asia region and also in Japan. So it was an exciting time to be in the region.
If you're managing debt in commercial real estate, it's worth checking out Lev. Lev's the AI platform for commercial real estate. Lev gives you one place to find lenders, launch deals, and keep track of responses without jumping between emails, spreadsheets, and CRMs. You can see everything that's happening with a deal across your team, all in one dashboard. Get the benefits of AI automation without the headache of building agents yourself. It's fast to set up and easy to use, and it's effective. Lev users are launching over $3 billion in deals every month, and they are loving the results. Visit lev.com to try it out.
Yeah, for sure.
Yeah.
Okay, so you finish your long career at Morgan Stanley, and that was 2011, you said?
Yeah.
And then what was I know at that point you're kind of looking for what's going to be your next opportunity. A lot of people had reached out to you at that point.
Yeah.
Give us a little.
Are you already at Lehman?
No. I left in 2011. I had 6 months of garden leave, and it was kind of a good time in my career to reset and try to figure out what I wanted to do.
So let's go chronologically a bit, because again, just Lehman Brothers is such a big name.
Yeah.
I'm so curious. I'm sure a lot of people listening would be curious, like what was involved in that process, and what were you working on? Well,
so what happened was, as you know, Lehman Brothers went bankrupt in 2008, and then it was managed by a creditors committee, and there were different hedge funds and investors that bought claims and all. It was an incredibly complicated situation. There was all these subsidiaries and foreign affiliates and different hedge funds and distressed investors had bought claims in all these different areas. So at the time that I left Morgan Stanley, a former colleague of mine at Morgan Stanley who was running one of these hedge funds called me. This was when I was on garden leave, and he said, "Look, we're about to launch Lehman Brothers out of bankruptcy, and we need to put together a board to oversee this process. And we think you'd be a great candidate for the board, and we'd like you to interview for it." So, at first, back then, certainly with what happened with Lehman, I had some reservations about it.
Yeah, the name was almost kind of toxic.
It just, had gone through this very public bankruptcy.
Right.
Yeah. But at the end of the day, what I figured out was, that wasn't what I was responsible for. What I was responsible for was the workout of basically all the assets. And it was a fascinating situation because not only did we didn't know exactly what we had, but we had about, let's call it 300. We actually had about $100 billion of assets.
Yeah, I know Archstone was one of the big.
Archstone and that was one of the reasons why they were interested in me. And one of my fellow directors, Rob Gifford, who is also a real estate person. But anyway, the other thing you had to do at Lehman, it wasn't just resolving the assets, but you had to figure out who your shareholders were. Because when Lehman went bankrupt and they had a bar date, basically they received over $1 trillion of claims.
Wow.
So part of the duties of the board was not only to try to resolve the assets and create distributions, but also to figure out who those distributions were going to. And so there was lots of negotiations, in some cases litigation, with all of these claimants. And those claims actually got skinny down to from $1 trillion to probably 300 billion or so. And then I think we generated about 100 to 125 billion of capital to pay out on all those claims.
I have the picture of you with the other installed board members at the time, sitting in a vacant boardroom in Lehman's office, just trying
empty boxes
with tons of papers, trying to figure out who's
papers
the real,
all over the floor.
Who's got the real claim? Yeah.
Well, no, I mean, it was a fascinating situation because obviously this was the largest bankruptcy in history by far, and the seven of us that got put on this project, none of us knew each other. I mean, no one knew. So it was like 7 people being thrown together to figure out this incredibly complicated problem. And that was looking back on it all, that's one of the joys of the project, is the relationships that we all have with each other. We are great friends. We have dinners together. We do stuff together. And, it was so in addition to being successful in what our project was, we created some personal relationships.
I'm sure, and the scale was
rewarding.
just, I can't even contemplate how big the scale was.
It was complicated.
Yeah.
There's no question about it. Because we had real estate, but also, there's a lot of derivative claims, private equity stuff, loans. I mean, you name it, any kind of complicated asset. And then some of them, The other complexity was it wasn't all owned by, this Lehman Brothers U.S. entity. A lot of it's owned in foreign affiliates, and they had their own issues and different claimants. And
a lot of legal fees, it sounds like.
There was a lot of legal fees paid, no question.
To be those attorneys.
Yeah. So where's Lehman Brothers Holdings today? What is it? What's it doing?
Yeah. Well, so what happened was the broker-dealer got purchased by Barclays. Mm-hmm. So that became basically the Barclays Investment Bank. And so what we were running was LBHI, Lehman Brothers Holdings, Inc., and it still exists. We've closed thousands of legal entities, and we're down to a handful. And it still has, I think most of the claims are worked out now, but it's still got, let's call it $500 million of assets. And the reason it's still going on is because most of this now is in the courts, and it's being, litigated, and so it just takes time for it to resolve itself. But our duties as a board still exist, but we just doesn't take as much time.
Got it.
Yeah.
I feel like you're owed a closing dinner at this point. It's been 14 years.
Yeah, it's been a while.
Somebody owes you one. Let me ask you, I'm jumping back a little bit, but when you started at Morgan Stanley and you worked there for such a long time, was there anybody you looked up to or was a mentor, or what really helped grow you in the real estate space?
Yeah, I do think that Morgan Stanley was critical to my professional development because of all the experiences that I got, at a pretty young age, in terms of leadership and responsibility, which I always appreciated. One of the things that happened while I was there is the real estate business grew dramatically from 1991 to 2005 when I left it. And not only advisory business, but if you think about it, back then there was I wouldn't call it a financial crisis, but there was a recession in 91, and it was very tough on real estate. But coming out of that, real estate turned more to Wall Street than it ever had. So, for example, the whole modern REIT industry was created after 1991 because including BXP, Simon Property Group, you name it, there were all these very significant leading companies that went public at that time. Before 91, the REIT industry existed, but it was a lot of much smaller companies. It was I hate to call it a backwater, but it wasn't really big at all. But so these companies all went public at that time, and public companies need investment banks as well as brokers, and so it made a company like Morgan Stanley more relevant. And then the second thing that happened was the debt securitization business. Before 91, most of the industry was financed with private mortgages. And after 91, that's when the whole debt securitization business took off. And of course, securities firms like Morgan Stanley were very central to that. And then also very importantly for my career, my predecessors raised the first real estate fund at Morgan Stanley, I think in 91 or 92. MESREF 1, and the timing was impeccable, and that first fund allowed us to grow a global real estate investment business, got us going at the right time. And so before 1991, Morgan Stanley's business in real estate looked a lot like Eastdil. We were very much brokers and financial advisors, and we were working on trophy properties and high-end properties, mostly in the United States. But after 91, it morphed because of the growth of those three businesses.
Yeah, I heard, sidebar, I heard after 2008, Roy March would walk around with a list in his pocket, just whatever's on sale. Yeah. And as he would take lunches, would sit down and go, all right, wow, which portfolio are you looking at? And just read you the price.
All right, so let's fast forward a bit to BXP and how you were tapped to basically succeed Zuckerman as CEO. That must have been a pretty crazy process, I imagine. Tell us how.
Yeah, so actually it's right when I started at Lehman. I got a call from an attorney who's a joint friend of Mort and mine. And I knew Mort. I didn't know him. I wasn't close with him, but Morgan Stanley had done a lot of investment banking work, equity offerings, things like that for, at the time, Boston Properties. Yeah. So I had met Mort on several occasions. But anyway, what was happening at BXP or at Boston Properties at the time is, the company was founded by two very talented executives, Mort Zuckerman, who you mentioned, and Ed Lindy, and they were, they were chairman and CEO. They ran the place as partners from 1970, and then they went public in 1997. And then Ed passed away in 2010, and so Mort became both chairman and CEO. And then when I joined in 13, he was also, or 12, he was, he was in his mid 70s, running an S&P 500 company as chair and CEO. So I think he and the board decided, they wanted a succession plan, and they decided to go externally. And
they normally don't go externally for things like this.
Normally not. No, definitely not. That was one of the challenges of the role, was coming into a company. And most of the executives that are there, most of the people that are on my leadership team are 20 plus year veterans of the company. That's very typical. So, my coming in was very untypical.
What do you think it was that they were looking for in going lateral that was different this time around?
Yeah,
or going external?
I'm sure you had talks with Mort at the time. And I'm sure he obviously had plans, and you had plans, but Boston Properties at the time was still a successful company, and they were doing really well. So not an overhaul.
I think this is kind of a broader comment on leadership generally in real estate, but I think you're really always looking for three things. You want somebody that knows about property. I mean, it's kind of obvious, but it's an industry. It's got its own quirks, and you got to understand the vernacular and have some experience investing and making money investing, and also losing money investing, and having those kinds of experiences to be successful. So that's part of it. I think the second part of it is you have to have financial experience. Real estate don't need to tell you, it's a very capital intensive business. So I think anybody that's a senior person in real estate has to understand capital. And then it's more complicated at BXP or any public company, because we actually operate both in the property finance world and also in the corporate finance world. So you really have to understand both, which I did because of all my time at Morgan Stanley. And then I think the third thing is people. You have to be a good leader of your own team, attract and retain the talent, but also you want to have relationships in the industry that are useful for the firm, whether it be with clients, that's our name for tenants, just to put that out there. And then also with capital providers and counterparties, for doing deals. So, and I did have a, reasonable network, because of all my time at Morgan Stanley working in real estate. So I think, those three things are, in my mind, are most important as a leader in real estate. And I'm sure those were the three things. Maybe those board members that were making the decision might articulate it in a different way, but I think at the end of the day, that's what they were looking for.
So paint the landscape a little bit of what Boston Properties looked like when you just joined, what your first impression was, what were you hopeful for and wanted to accomplish with it versus, what has transpired maybe?
Yeah. Well, so I have, in my career, as you've all have touched on some of them, I've been kind of airdropped into some different leadership positions. And I think the most important thing to assess right away is what's needed. Is this a turnaround where, the company's underperforming and you've got to make some very serious changes to be successful in the future? Or is this company performing well and it just requires, a leadership transition? And I think BXP was definitely in the latter category. I mean, that's what attracted me to the company. I thought the culture was very much, have the highest quality buildings, conduct business in the highest quality manner. We always have the highest governance ratings. We do everything the right way. Ethics is super important. So I thought that was a great fit for me, and that was a real attraction. And then Mort was an attraction. I knew him. He's a brilliant person. He did a ton of stuff outside of real estate. He owned the Daily News. He still owns U.S. News and World Report. He was an advisor to presidents back to, I think, Reagan on matters in Israel. I mean, just imagine today if he was still in that role with all the things going on in Israel. So I always thought he would be a fascinating person to work with. Yeah. So all those things are what attracted me to the company.
Who was, to the extent you recall, right? You get tapped for this job. Did you call anybody who was your sounding board in making this decision? if you had any?
Well, my wife was probably the first for sure.
Was it like, how you don't see me much? I got my hands full kind of thing?
Yeah. No, she's, having a career at Morgan Stanley, she's accustomed to focusing on, one's work. So, but, honestly, this job has not had the same level of global travel and things like that, it's certainly intense and takes a lot of time and a lot of responsibility, but I'm also not gone for, 2 weeks at a time.
Yeah, and you're staying domestic.
World.
I mean, you're mostly...
Yeah, I travel a lot, but it's all domestic.
Well, maybe we should talk about the markets that you guys are in a bit. Speaking of where you're active, where you're traveling to, and these gateway cities.
Yeah.
I think, everyone talks about New York and the revitalization of office today. Office has been considered kind of dead for a bit. I don't know why I'm telling you this. And now I feel
not dead for Owens.
I feel like you can't get enough of it, at least in the right pockets for the right product. So what's going on right now?
Yeah. Well, I will say I've been at BXP for 13 and a half years, and the work from home phenomena is my third existential crisis. Okay,
I'm surprised it's only the third.
I had two before that. So the first one was densification. Because when I joined, this was the era of the tech companies. They were all growing like crazy. Google, Amazon, they were all taking space. Markets changed. San Francisco, south of Market.
Yep.
New York City, Midtown South. So the cities were, I think, more or less the same, but even their districts changed. So, but it was densification. You all are not going to be able to lease space because these clients are going from, 400 feet per employee to 75, and they're going to press them in so close, and you're never going to lease any space. So that was one. And then came co-working. The WeWork phenomena, a major brokerage firm who will not be named on this podcast, wrote the report that 50% or something
will be co-working
of the office space in the U.S. is going to be co-working, and we weren't going to be able to. Every question we got was about what's your lease term?
Why isn't everybody so tired of it? Yeah,
and I kept pointing out, look, if you're a major corporation and you're going to spend all this money to build out space in an office building, you don't want a 1-year lease.
Right.
You want a 15-year lease of quiet enjoyment to make sure your rents are locked down and that you're, amortizing all the work that you put into the space. So anyway, we got through that. I would say of these three, however, I do think the work from home was the most serious one because, when this started in March of 2020, the first things we started hearing from some, not all clients, was, well, do we need to keep paying rent? Because, we're not using the space, and in some cities you weren't even allowed to use the space. And so there was a lot of discussion about that. So we got through that. And then, I don't know if you recall this, but there was a strange period where people weren't coming to the office, but interest rates were so low. There was all this commercial activity going on.
Yeah.
And so that, of course, tech companies were taking lots of space, even though they weren't really using it. And
it's free money.
This odd period. I would say, 21 was probably the heart of it. And so, the leasing was okay during that period, but I'm not sure it was because of use. I think it was just because of the availability of capital and opportunity. Yeah. And then we had, the interest rate rise of, what was that?
22.
Yeah, 22. Yeah. Was it 22 or 23? I
thought it was March 22.
Okay. So
something
let's
like that.
It was like June that summer. Right. And rates went up. I always say office demand is correlated to two things. One is the client using the space, and second, what's the corporate health? Are their earnings growing? Are they trying to grow their businesses? So I would say in that 21-22 period, you had strong corporate health, but they weren't using the space. When interest rates started going up, you had both problems. So that was a tough period. I would say from when interest rates went up until the middle of last year. And I think 24 was the bottom. And now what you're seeing is there's more and more companies returning to the office, and certainly corporate health is better. With interest rates, at least not going up anymore, with the prospect of them going down. S&P 500 earnings are forecast. The projections are coming down, but they're still forecast to go up 7 or 8%. And that's not all our clients are S&P 500, but they're a good proxy for what the corporate health is.
It's interesting. Your product that you're selling is such a good barometer, it sounds like, for the greater economy.
It really is. I mean, we have a little, because we have, obviously, if we're leasing to Google, we're not doing a lot of credit analysis, but we do have a lot of clients in the tech world and the life science world, where credit analysis is a big part of it. So we have a whole team that looks at all those kinds of things. So
and the data you have, and I'm sure it's
we have a feel for it. But if we've charted our leasing, and I do think that correlates most to S&P 500 earnings growth. I think that really drives
the type of the caliber of your client, the size of your client base.
Let me ask you something about the work from home impact. Obviously, it affects space. Have you found that your tenant base has reduced space or started using it differently and kept the space?
Yeah, I think it depends on the client. I think when we look at all the leasing that we're doing now, it's up quarter over quarter. It's up, last 12 months over last 12 months. And we definitely have more expansions than contractions. And I think these companies, but every company's got a different story. Like if you look at the law firm world, many of the law firms, they have a strategy of growing. They're hiring new partners and they're growing. It's not necessarily because they're a partner is generating more revenue. I think they're just growing as a firm. So it's very case specific. But you have other firms. I mean, look, I think that companies are definitely returning to the office. I quoted this Fortune 100 survey on the last earnings call, and the fully in the office over the last 2 years has gone from like 5 or 6% to like 55% for the Fortune 100. That's a big change.
Yeah.
But the hybrid went from like 80, but it's still like 40%. So the issue's not gone, but it is improving.
If you're managing debt in commercial real estate, it's worth checking out Lev. Lev's the AI platform for commercial real estate. Lev gives you one place to find lenders, launch deals, and keep track of responses without jumping between emails, spreadsheets, and CRMs. You can see everything that's happening with a deal across your team, all in one dashboard. Get the benefits of AI automation without the headache of building agents yourself. It's fast to set up and easy to use, and it's effective. Lev users are launching over $3 billion in deals every month, and they are loving the results. Visit lev.com to try it out.
Yeah, that's an interesting dynamic to me because it feels like there's been enough time where people have found the solutions, but yet I guess companies are maintaining this flexibility.
Yeah.
I personally, I don't know too many people with, I think hybrid in its true sense doesn't really work because if the whole point is to have you together and then I come into the office and you're out and I have to Zoom call with you, then
but I would say, I don't know, do people really need to be in the office Monday through Friday? I mean,
well, what's happening is you're 100% right. We don't like it, but the fact is people will come in less days a week, but the employers are generally saying you got to be here, Monday and Wednesday and Thursday, or Thursday and Friday,
whatever the
day is.
Yeah.
So they can't really take less space because they need space for everybody.
Right.
But when they're using all their space for 2 days a week or 3 days a week versus 5, that's
still need that space.
You still need it, but it's still
or sort of the
positive.
fractional ownership of it, right? Where you have the one employee using a space Monday, Wednesday, and the other
hot desks or hotspots.
And by the way, we track all the, we have 54 million feet and we have the badge data for about half of it. And New York's back to where it was, but on Friday it's not. Right. And by the way, but even before the pandemic, Friday was dropping off.
I believe that. Whenever I'm in the city and it is a Friday, I always ask myself, does anyone work?
Yeah.
I mean, it's just totally dead.
But to your point, Owen, I think that's really interesting. Not enough investors, whether it's the macro investors or capital allocators, they put enough emphasis on that. So, okay, Fridays are gone, but when you're there Monday through Thursday and you still need to fill all the desks, you can't really give that space up. So
I think the other thing I would say on the work from home, the reason I think that the hybrid it may shrink from where it is now, but it's there to stay. A couple of things. Most companies have said the back office doesn't need to be in the office all the time. Even at BXP, we have a more liberal remote work policy for our accountants, HR people, IT people. And that's true across the industry. If you go to a major bank today in New York, they'll say, if you're a trader, investment banker, portfolio manager, you have to be in the office 5 days a week, and here's your desk. But if you're in the support areas, they say, well, it's up to your manager, and if you want to come in, we'll have a desk for you. And they have, one desk for every 1.8 employees, something. So
that's really the impact. The impact, to an extent, does weigh on verticals of the business.
Yeah,
or
I think
tiers
it's
of the business.
function. And then I also would say, look, there's small companies that are competing. The way I look at remote work, it is it's an employee benefit, just like compensation. It's got a real cost to the organization, but some people use it to attract and retain talent. So if you're like in the tech world, if you're not one of the major tech companies and you're trying to compete with them for talent, you go to the engineer or whoever you want, and you say, look, come work for us and you can live in Bozeman, Montana. Right. You never come to the office, but we just need you to do this work. And that's how they're competing for it.
Are you noticing more employees returning back from remote places to the San Franciscos and the New Yorks from places like Florida, right? Where we saw mass exodus too. Do you see them coming back now that we've kind of recovered from COVID?
Well, let me, yes, but I would qualify it. So the other phenomena I would say on work from home that's important is it's also regionally specific. So the West Coast is so far behind the East Coast on return to the office.
Why is that?
I think it's culture.
Yeah.
I think it's absolutely work culture in the West, versus the East. I mean, it's a little bit because the tech companies are a little bit bigger as a percentage of total. But I don't know. I don't have this data, but I would expect and would wager a lot of money that there is a lot more office attendance of Google employees in New York than in the Bay Area.
We need CRE Daily to put together an index of companies, how they're performing based on geography, West versus East.
But one exception to that, though, is these AI companies, which are now growing rapidly. I mean, they represent 15 to 20% of the leasing in San Francisco. They're in the office probably more than 5 days a week.
That's very interesting.
So
you wouldn't think that, actually. That's interesting.
Yeah, they work
It's
in
tough
person.
to gauge the tech market because there's so much connectivity. You're obviously on your computer all the time. You're making your product, so you have to be connected. So to that point, you could be in. Why can't I be in Bozeman, or why can't I be somewhere else?
Let's talk about office product. I mean, you guys develop a ton. When do you decide to develop? When does it make sense? When does it not make sense? And I think the interesting thing is there is a lot of older product out there that's being converted to residential or just being taken offline altogether. So where do you fit in there?
Yeah. So let's talk a little bit broader about the office market, and then we'll come to development. So given the work from home phenomena that I just described, so what's happening is, first of all, there's a bite on office demand. It's down because there's going to be some level of permanent hybrid work. So that's down. But then the employers that are coming to the office, they want to make the office great because they want to, these are like leading law firms, banks, technology firms. Yes, they can mandate being in the office, but they want to lead with carrots, not sticks. Right. And one of the carrots is our office is in a place that's easy to get to. That's super important, right? If everybody is asking the question every day, is the commute worth it? If the commute is easier, it's more likely to be worth it. And then when you get there, it's great. There's amenities, and some of those amenities we're responsible for as the landlord, and then some of the amenities the client has to put them in the space. So we call it the premier workplace segment, but we've had CBRE study this, and in our core markets, I think the premier buildings are certainly under 10% of total. It's probably about 15% of the space. And, the vacancy rate's 12% versus 20 for everything else.
So this is across geographies.
Cross geographies.
Okay, that's very tight, considering, people talk about office in New York, and that's a 17% vacancy on the overall market or something.
But we're going to come to 343 Madison in a second, but I think the vacancy rate for the buildings that we compete with is like 6% for that property. And by the way, the asking rents for the premier segment are 50% higher than the rest of the market. So
it's incredible, isn't it?
You've got all this pressure, going into the top of the market. And so the good news is we're well positioned for that because that's always been the company's strategy. But even with that, we have to redouble our efforts. And it also makes us want to be a developer as opposed to a buyer because every building, there just haven't been that many what I'd call premier buildings that have been sold, since we've come out of this, or we're coming out of this office funk.
Well, let's focus on New York for a second, right? Meaningful deliveries are pretty much, I don't want to say at a complete standstill, but as close to the bottom levels.
Pretty close to zero.
Pretty close to zero
it's
until
true across
2030.
The country. Yeah.
So 343 Madison.
Yeah.
Obviously, there's a need for this premier work segment.
Yeah.
How are you balancing costs with what you're getting? And it's all numbers.
Yeah.
Right?
So the reason why the office development has really come off is that bite from demand I talked about, but the costs have skyrocketed. We think construction costs per square foot since the pandemic are up 50%. I mean, that's huge. So 343 Madison, I mean, it costs $2,000 a square foot to build that building. We need rents. And by the way, not only have hard costs and labor costs gone up, but capital costs have gone up. Yep. So we used to build in New York to a 6, now it's an 8. So, so not only have we, is the cost per square foot of the building higher, but the yield that we require, or our capital providers require, is higher. Let's talk about 343 Madison for a second. Okay. So this building is at 44th and Madison. It's right behind the Yale Club, so it's half a city block. Very uniquely, it's got an escalator in the lobby that goes into the Madison concourse. So I don't know if you've used that yet, but it's fantastic. And the one to the north is at the JP Morgan, 383 Madison, and the one to the south, I think, is at 1 Vandy. So just couldn't be for, going back to, I think the most important thing for an office today is transit. Like, you can lease a B building in the Grand Central area because of the access to transit. So now we're going to have a brand new building.
Yeah, forget about it. You got everything.
So we've got that. And then the building's about 930,000 square feet. The floor plates are about 25 at the bottom, and it goes to like 22 at the top. And that's the trickiest part of leasing the property because, a typical building in New York is going to be like 30 to 40,000 square feet. Mm-hmm. And if you have bigger plates, you can get, a 500,000 million square foot anchor client. But a client that large isn't going to want to spread out over that many floors. So, we've announced that we have a letter of intent with an anchor client, and they're 275,000 feet, which frankly is bigger than I thought we would get.
That's really big.
So it's about 30% of the building, and we're in discussions with another one.
Can we talk about them for a second? Obviously, no, we're not pressuring for names.
Yeah,
but
sure.
When you have somebody like that and 25,000 square foot floor plates, what was their logic in taking multiple floors? It's obviously a very big portion of the building. How is somebody like that comfortable with it? It's obviously a big institution to be able to anchor 275,000.
Yeah, no, I think they want to upscale their space. For all the reasons I mentioned earlier. They want to have a great workplace for their employees. It's sitting right on top of Grand Central, so it's super easy to get to. They want to have a great space for their clients. I mean, think about this JP Morgan situation. I mean, the building that they are delivering right now is extraordinary. I've been through it a couple of times. It's extraordinary what they've built there. The trading floors, all the amenities that are in the property, food, any personal services that anybody needs, the office space, the meeting space at the top, I think, is the highest space in New York where there's, activity going on.
Crazy.
And so now they're going to have clients and employees coming to that building. I think other financial institutions are going to
have to copy that.
Yeah, I don't think they'll be exactly able to copy it, but they've set a new benchmark for the market, and that's going to help.
And that was announced. I mean, that's pre-COVID. During COVID day. I mean, so I guess Jamie Dimon is really going all in on office, even when a lot of people were not, I guess, right?
Well, look, I obviously haven't spoken with him about this, but I think they decided they had an extraordinary piece of real estate. They owned that whole block via state, and it was an older building, and they're an extraordinary institution. They've experienced tremendous growth, and they felt it was worth it, to have a modern office building for the future.
And there aren't really any full full avenue to avenue block buildings on Park Avenue.
It's crazy.
I think maybe one or two that I could think of. Yeah.
So you mentioned you're targeting 8%.
Yeah. So coming back to development. So what's going on with us is we very much want to be a developer, but it's harder. I mean, we have sites, particularly in the suburbs and certain locations, that I just don't think are going to be office anymore. So we're actually re-entitling them to residential and just selling them. But we have a handful of sites that I still think can be office. 343 Madison's a great example. We announced last year a new project in Washington, D.C., of all places, at 725 12th Street, which is right on top of Metro Center. So we bought a building for $110 a square foot, and we're basically tearing it down, and we're using the foundation in the garage. And concurrent with that purchase, we also leased the building to 2 law firms that are paying the rent required for us to get to our 8% yields. Wow. And so it just shows you, these law firms want to have new space, and they're prepared to pay for it.
And you can still find those deals. You can still find things that pencil.
I mean, I think, these don't come along every day, but if, we could do a deal like that every year, it would be terrific.
So,
I was gonna, we talked a lot about New York. What about San Francisco? I mean, this is a market that people just keep crapping on.
Yeah, that was my next question as well. Is how are you? We're connected today. It's good. How are you balancing? New York's like 343 Madison is such a hyper specific example. You're right. In such a big city, if you're on Grand Central, effectively, it's a game changer. But how do you balance DC, San Francisco? What's your perspective on those?
Let me just finish a little bit in New York, and we'll go to these other cities. So there's other development going on in New York. So Related got Deloitte to anchor their building in Hudson Yards. We have a site, by the way, at 3 Hudson Boulevard that but we're not going to launch that until we have a major pre-lease. And then Vornado and Citadel and the Rudins are doing a project 2 or 3 blocks north of the JP Morgan headquarters. And they're in ULURP now, and that's going to happen. I mean, they've got a signed deal for that. So you're starting to...
RXR is trying to do one in front of Grand Central on 175.
That's a big project. It's mixed use. It's harder, even harder to do, I think. But so you've got a few things like that could come. If you look at the other cities, the Washington, D.C. is really build to suit, where no one's going to build a spec building. But if you can put together the deals the way we did, and we're working on another one now, by the way, in Washington, I think that's possible. We have a terrific site in Boston called 171 Dartmouth that is right over the Back Bay Transit Center. And, where rents aren't quite high enough yet in the city to justify that development. But I think at some point they will be, and I think we'll launch that, probably not in the next year or two, but I think at some point that will come. I think San Francisco is behind all that. The market is starting to recover. We are starting to get positive absorption, but the vacancy rate is still in the 30s broadly, and it's probably in the high teens for the Class A properties. So I think, rents and so forth are still pretty far away in San Francisco to support development.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
It's also interesting because you were talking before about the costs in New York, right?
Yeah.
Costs go up 50%, capital costs go up. But yet, New York rents are still high enough in the good areas where you can justify that. How does that work in Boston, San Francisco, D.C., and in what are supposed to be cheaper markets? The costs are still the cost, and the capital still as expensive.
Yeah, it will go up. Yeah. That's what office does. I mean,
focusing your energy.
When I don't have all this data in front of me. When I started in real estate in 1987, the rents in the GM building were, I don't know, mid to high double digits. And then when I started at BXP, probably 13 years ago, the bottom of the building was probably 100, and now the top is 200. Now, I would say the whole top half of the building is over 200. And the reason that is, it kind of goes back to our strategy, is, look, it's inflation. Because companies want to be in these great buildings, they cost more to build, and so you have to pay the client has to pay that rent.
It's one of the benefits of
or they
real
won't get
estate.
the building.
It's
So if you have the
it
right
catches up.
asset, now look, there's some buildings you would own in New York where that wouldn't happen, right? Because they're older, they're not well located, they're getting converted to residential. But if you have timeless assets in a great location that you nurture and amenitize properly, you can get that inflation benefit. And I think that's what we're always trying to articulate to our shareholders is that, this one of the positive, I don't like it as a developer, but development's going to zero. And guess what? We do have 54 million square feet of space that's going to benefit from having no development. And we are going to pick off a few developments here and there.
It's funny to get it through such a simple lens. I mean, that clearly you're doing a good job articulating it, whether the investors are picking up or not. But
well, you have a track record. It certainly says something. I'm curious about let's call the suburbanization of office. In DFW, I keep seeing these. I'll call them hubs, right? Outside of the CBD, where more employers are moving to, more office space is being taken up. What's BXP's take on that?
The reverse.
So you're going all in on the core.
When we look at our portfolio today, what's our occupancy today is about 87, 88%. It was 92. So the big opportunity that we have for shareholders, look, we're doing these developments and we're excited about it, but the big opportunity to grow the income per share is to get the buildings more leased. So if you look at the CBD buildings, their occupancy is only down like 2-3%. The suburban buildings are down like 15%. So at least in the gateway markets where we are, New York, Boston, San Francisco, Washington is a special case for us because we have Reston Town Center, which I'm counting as urban. But if you pull that out, these suburban areas are hurting, and because people aren't using the space, our parking lots are not full, and it's much harder. So I think our direction, in addition to continuing to push on this quality pedal, is going to be less suburban and more urban going forward, at least in the cities that we're in.
And have you discussed getting more into Texas?
I think the other thing that we should spend some time on, because this is going to be the fourth existential crisis, is AI.
Okay.
I
So
thought it was just going to be Texas.
So it's going to be AI.
Texas crisis.
Rightfully so, everyone's starting to, and I've been talking about it for a while, but now all of a sudden all these CEOs are bragging about the jobs that they can not have to hire or let go because of AI. So that obviously creates a question for office. So in our view, that is something to pay attention to, but our view is that there are going to be jobs that are both created and disrupted by AI. And the creation of the jobs is going to be where the talent is located, with the leading firms that are creating these products and supporting companies that are creating the products. And where the jobs are going to get disrupted is in the whole support areas, accounting, IT, areas like
Which
that.
are areas that we were just talking about,
Office services.
Are more remote to begin with.
Right. So I think that if you looked at the nature of the workforces in the cities, I think the gateway markets where we are going to be more insulated from AI impacts. Because, look at San Francisco. Most of the leasing that's going on right now, or certainly the net absorption, the leasing that's creating net absorption is coming from AI companies. So they're creating jobs. They're not destroying them. Yeah. So that's why we've always had this gateway strategy, more because it's been, going back to what I was saying earlier, we want to own timeless assets and hold them. And if you're going to do that, you've got to be in markets that grow, but that have barriers to supply. And I think I would add to that today with this whole AI phenomena. I think the gateway markets where we're located are better positioned to be insulated from that.
Interesting.
Yeah, that's really well said. Well, it's rare that we get somebody with as much experience as you have, who's in such a position where you get to see a lot of the macro data. It influences exactly what you guys are doing. We deal with obviously a lot of operators who kind of take what they can get sometimes. But what's shaped you in your career? What do you think the most? And whether it's people you've worked with or people you've worked under, for, partnered with, what's helped shape you and your view on real estate?
Yeah, I think it's definitely people. I think that's always the most important thing. I started off as an engineer, so I was very, analysis, problems, answers. But And it's all good. And you need to be able to do that. You know, that's your foundation. You always have to look at the spreadsheet before you make an investment. But those are just kind of, to me, the guardrails. You know, it's really about the people, the judgment. Like when we're making a big decision at BXP, you know, we've got the right people in the room. We've got our people that are more opportunity driven. You know, this is going to be great, you know, and here are all the positive things that are going to happen. And then we've got our risk managers in the room that can look at all the downside, and then, you know, we figure it out. So I think I've learned the most from people. And then I think as a leader, one of the most important things I can do is create a culture where all those people, like we have the best people that do those things, and they're all comfortable sitting down and really sharing what they think. And then if it doesn't go their way, they understand why and they don't get upset about it. I mean, a couple of times in my career, I've had this situation where we sit down like that, we make a decision, and then somebody comes to me later and says, well, you know, I didn't really agree with that. And they didn't say anything in the meeting. I'm like, well, you know, you lost your chance. You know, you gotta speak up and you gotta participate.
And it's probably easier when you're in person in the office.
No, there's no doubt about that.
There you go.
Yeah, no, I've heard this, you know, I think it's true. And people that are portfolio managers in investment management, you know, on Zoom, it's harder to get people to really say what's on their mind, right? To really, you know, first of all, to engage fully, and then to really say what's on their mind.
And I think the tricky thing is we have this whole generation that's being brought up more used to Zoom than being in person. So how will that
Jack can't speak to me if it's not on his iPad. It's getting really hard.
I wonder about that, though, because I have 3 young adult kids, and they're in various stages of starting their careers. And they all, I mean, maybe it's because I'm their dad.
Yeah, it's because of you.
But they're like, well, we don't want a remote job. You know, we're not going to learn anything. We want to be in the office.
I think it's very true.
Yeah, I thought it was tough. I mean, you weren't, you know, a young attorney so long ago, but when you started out, you wanted the exposure, right? You learned from the people who have the experience. You have to be there in person.
Yeah. I think the tougher part on the remote work is executives that are
I've heard that it's the reverse.
30s and 40s, because you know I get this because I remember those days. You know, you know enough now where you can work remotely. You've got your clients, you know how to do things, and then you're dealing with small children, family issues, and it's just harder to come in. And I think that's that's the cohort that I think is that desires the most to have the remote work.
It's a great point. I've thought about that too. Yeah. And they're so key in every organization structure.
All right, ended on this note. Tell me, I'm going to keep it as simple as I can. What's it take to be an effective leader? What do you think you do that's effective in your style, or you try to implement?
Make everybody first of all, surround yourself with the best people. Create a culture where everybody is comfortable speaking, but also be prepared to be decisive when you need to and make the call.
Yeah. What's your style? Do you have a lot of like little touch points throughout the day, or do you do one?
Always talking to people, calling, and so forth. I mean, when we were faced with a big decision or something, you know, we'll have a formal meeting and we'll all sit down and talk about it. But I'm always, you know, talking to my colleagues, board members, counterparties, clients. I mean, it's kind of the fun of the job is the diversity of it. Yeah. And many days, I mean, I have a schedule that's set forth, but a lot of days I don't even really know exactly what's going to happen.
That's exciting.
Do you think what do you think makes BXP successful? Is it the speed at which you operate, or is it your ability to think through the more complex
I think it's issues? The focus on quality and ethics, and always doing things the right way, and having a very clear strategy and following it closely.
Oh, that's great.
Owen, thanks so much for coming on.
All right, my pleasure. Good to be with you guys. All right, thank you.
Thanks.